Most Australians scroll past the ASX every single day without realizing the 5 companies sitting at the top of it are quietly shaping their superannuation, their economy, and their financial future. And here is the part that should make you stop and pay attention. You probably already own a piece of these companies and have no idea. Because if you have super, you are almost certainly invested in every single one of them. The question is whether you actually understand what you own, why it matters, and what the 2026 market is telling us right now. Today I am breaking down Australia's top 5 shares by market capitalization trading on the ASX right now. Not just the names and the numbers. The stuff that actually matters. What each company does, why it dominates, what the risks are, and what an informed Australian investor should be thinking about each one. Let us get into it. Number 1. BHP Group. BHP is the biggest company on the ASX by market cap, and it has been for most of the last 2 decades. This is a global resources giant. Iron ore, copper, coal, nickel, the kind of stuff that builds cities and powers economies. When China is building, BHP is printing money. When China slows down, BHP feels it first. That relationship is the single most important thing to understand about this stock. Right now, copper is the story. The global push toward electrification, EVs, renewable energy infrastructure, all of it runs on copper. BHP has been positioning hard in this space, which is why long-term investors are watching it closely even as iron ore prices stay under pressure. The risk here is concentration. Australia sends over 80% of its iron ore exports to China. If that relationship shifts, BHP shifts with it. It is a world-class company, but it is not a set-and-forget story. You need to know what you own. Number 2. Commonwealth Bank of Australia. CBA is the most valuable bank in the Southern Hemisphere and regularly trades at a valuation that makes global analysts scratch their heads. The price-to-earnings ratio on CBA sits well above its international peers. Yet Australian investors keep buying it. Why? Because CBA is not just a bank. It is infrastructure. More than 10 million Australians bank with CBA. It is deeply embedded in mortgages, business lending, retail banking, and increasingly in digital financial services. The May 2026 federal budget changes around negative gearing and capital gains will ripple through the property market, and CBA sits right at the center of that. More first-home buyers using new build incentives means more mortgages. Changing investor behavior means shifting loan books. Watch CBA closely over the next 12 months because the property policy changes are only just beginning to land. The risk is its premium valuation. If sentiment shifts or credit losses rise, that premium can compress fast. Number 3. BHP is already covered, so let us go to CSL. CSL is Australia's quiet global giant. Most Australians have no idea this company operates in over 100 countries and is one of the largest biotech and blood plasma businesses on the planet. CSL makes life-saving therapies for people with immune deficiencies, bleeding disorders, and rare diseases. It is not a mining company. It is not a bank. It is a science business that compounds quietly in the background. CSL's growth is driven by demand for plasma-derived therapies, which is rising globally as populations age and diagnosis rates improve. The risk with CSL is currency. Most of its revenue is earned in US dollars. When the Australian dollar strengthens, CSL's reported earnings take a hit even if the underlying business is performing. For long-term investors, CSL represents something rare on the ASX. True global diversification inside an Australian-listed stock. Number 4. National Australia Bank. NAB sits alongside CBA in the Big Four, but plays a very different game. Where CBA dominates retail banking and consumer mortgages, NAB has historically been stronger in business banking, small and medium enterprise lending, agricultural finance, and commercial property. In 2026, with business conditions still adjusting to higher-for-longer interest rate expectations, NAB's loan book is under a microscope. The business banking focus means NAB is more exposed to commercial property stress than its peers. But it also means it captures more upside when business investment picks up. NAB has been actively streamlining its operations and investing in digital infrastructure. The dividend is solid. The franking credits make it attractive for retirees and SMSF investors looking for tax-effective income. The risk is its exposure to a commercial property cycle that is still finding its floor. Number 5. Westpac Banking Corporation. Westpac completes the Big Four's grip on the top of the ASX and rounds out a list that tells you something important about Australia's economy. We are a resources and banking nation. Westpac has had a turbulent few years. Regulatory issues, management changes, and a major remediation program have consumed significant capital and attention. But the turnaround story is real, and it is progressing. Westpac's mortgage book is enormous, and its retail banking network runs deep across Australia. With property market dynamics shifting under the new budget rules, Westpac's ability to adapt its lending strategy will be critical. The franking credit yield makes it attractive in a low-growth environment. But like all the Big Four, the question is not whether Westpac is a good business. The question is whether the price you pay today reflects what it will earn tomorrow. So here's what this list is actually telling you. Australia's top 5 companies by market cap are 2 miners and 3 banks. That is it. That is the concentration risk sitting inside every Australian index fund and every default super option in the country. If you are only invested in ASX-focused ETFs or a default super option, you are betting heavily on Chinese demand for resources and the Australian property market holding up. Both of those things might be fine, but you should choose that bet consciously, not by accident. The Australians who build real wealth are not the ones who own the most shares. They are the ones who understand exactly what they own, why they own it, and what would have to go wrong for them to be wrong. That is the edge. Go build it. If this video gave you a clearer picture of what is sitting at the top of your market, hit the like button, subscribe, and turn on notifications. I will see you in the next one.